How's it going, YouTube? My name is Ari and welcome to Blue Lion Finance, a channel dedicated to investing in my very own personal journey to amassing $100,000 with my Vanguard brokerage account. Now, week to week, as I give those account updates, it may not seem like we're making any progress, but matter of fact, we are, because we are allowing ourselves to double down on high quality stocks as they go on sale amidst all of this volatility. Now, rather recently, with tensions between Russia and Ukraine only heating up, Russia is bombarding Western Ukraine. Ukrainians are not letting up in the slightest, and now we are inching closer day by day to the Federal Reserve hiking those interest rates. I personally believe that this week is going to be extra volatile. Stay on your toes, keep your eyes on the market. Now, amidst all of this very volatility, my account certainly took a hit, falling by $221.29, whereas it is now sitting at $82,648.96 on the day. In terms of today's video, I want to get right to it and talking about 7 high quality dividend stocks that are overexposed to Russia, meaning that they are now trading at fair or even discounted prices that we can capitalize on. Ultimately, it's a video you will not want to miss out on if you are that long-term value investor. Tap on that thumbs up button just before we dive in. And of course, if you haven't done so already, subscribe to the channel. I want each and every one of you on this journey with me. Now, YouTube, let's go ahead and dive right in. So if you are anything like me and asking yourself where exactly you should be investing, I personally like to go back to Warren Buffett's words of wisdom when he shared that one should be greedy when others are fearful and fearful when others are greedy. Those very words of wisdom lead me right to what's happening between Russia and Ukraine, because right now there are a lot of companies that are exposed to both markets, but I particularly want to take a look at the Russian market and what companies are exposed to the Russian markets, because a lot of them, of course, were hit pretty hard and now are trading at fair or discounted stock share prices, which is exactly what the long-term investor wants to be capitalizing on. So today's video, once again, is 7 dividend stocks that we can double down on right now that are trading at discounted stock share prices, and just kick back, relax, because at the end of the day, geopolitical matters typically smooth over time, and voila, there we will be with our ROI. This all now leads me to talking about the world's largest fast food chain. This company is McDonald's, ticker symbol MCD. Now, many of you, of course, know McDonald's, and I'd like to throw it out there that McDonald's was founded back in 1955 and has since its founding only built an empire with over 38,000 locations operating in over 119 countries. Now, McDonald's has had a very rich history with Russia, and upon the first opening of their first location there, they had media coverage up the wazoo and a line, I'm talking about a real line of 30,000 plus people that wanted to try out McDonald's. Now, the war between Russia and Ukraine certainly shook McDonald's stock up, and a lot of pressure was placed on McDonald's to actually take a stand against Russian aggression by closing locations down. So ultimately, they did just that in closing down 850 locations throughout Russia. Their stock share price then slid thereafter, falling from $270 per share all the way down to now around $226 per share. That is about a 16% change and a massive opportunity for all of us long-term value investors to scoop up McDonald's, that has not been trading at these valuations for quite some time. Its current PE ratio is sitting at 22%, which of course could come down a little bit more, but hey, I'll take what I can get when it comes to McDonald's. They have 9% of their revenue now missing between Russia and Ukraine, and those markets just disappearing temporarily. However, I personally believe McDonald's is going to be making a quick recovery. So too do analysts, coming in at a median stock share price of $283 per share, a high stock share price priced at $306 per share. Now, until it makes that rebound, we're just kicking back to collect on McDonald's dividend, with a current dividend yield coming in at 2.48%. This is definitely a dividend investment you want to add to your portfolio. Right along with the world's largest fast food chain, we have the world's largest coffee house chain. We are talking about Starbucks, ticker symbol SBUX. Starbucks was founded back in 1971, and since their founding, they too have amassed an empire of their own with over 33,000 locations operating in 81 countries worldwide. And most importantly, is they have faced a very similar trajectory to McDonald's, with Starbucks facing a lot of heat for not closing down shop in Russia, which ultimately they did do so, closing down 130 locations temporarily, which led to their stock share price falling from around $116 per share all the way down to $82, $83 per share. That is nearly a 30% change, and another beautiful opportunity for the long-term value investor to pick up Starbucks while it's trading for these valuations. With their PE ratio coming in around 22%. Now, Starbucks only lost about 1% worth of their revenue generation for closing down those 130 locations, and I honestly just predict that Very similarly to McDonald's, they're not going to be going anywhere anytime soon. Geopolitical issues will eventually dissolve, and Starbucks, before we know it, will be in that recovery mode, coming back up to a median stock share price of around $115 per share, and a high stock share price, at least according to analysts' expectations, upwards of $136 per share. And until it reaches that stock share price, we're just sitting pretty on Starbucks' dividend, coming in at a dividend yield of 2.25%. Next up, let's take a moment here to just talk about the world's largest soft drink manufacturer being impacted. This company is Coca-Cola, ticker symbol KO. Now, Coca-Cola dates back to 1892 and has literally a global footprint around the world. It's 10 bottling plants in Russia, with Russia bringing in about 4% worth of Coca-Cola's revenue generation. Certainly, it would not go unscathed. Now, just as soon as Coca-Cola made the decision to close down those bottling plants in Russia, their stock share price certainly took a hit, falling from $62 per share down to around $57 per share. Not the largest change in the world, but that still nonetheless is 8% worth of a change, and perhaps presenting now a bit of an opportunity for the long-term value investor to get invested into an incredibly high valued company like Coca-Cola. Their PE ratio is coming in around 25%. Now, looking into Coca-Cola's future, analysts do believe there is a lot of growth ahead of it, especially after these geopolitical issues dissolve. Their median stock share price is coming back up to $67 per share and a high stock share price of $76 per share. And of course, just as the others were collecting on Coca-Cola's dividend, with their current dividend yield coming in at 2.85%. And if we're getting busy talking about Coca-Cola, we might as well talk about their biggest competitor. We're talking now about Pepsi, ticker symbol PEP. Now, Pepsi was very quick to follow suit in Coca-Cola's footsteps. Of course, they were nowhere near as large operationally in Russia, but nonetheless, they were facing a lot of the same pressures. Now, Pepsi only has 2 bottling plants within Russia that have since then closed down. However, Russia still makes up about 4% worth of their global revenue, causing a lot of volatility when it comes to Pepsi stock, falling from $175 per share all the way down to $153 per share, about a 12.5% change. Another great opportunity here to pick up Pepsi, which is a world-class dividend investment in my opinion. Now, it has a bit higher of a PE ratio, coming in around 28%, but nonetheless, it's about their future, with analyst expectations coming in at a median stock share price of around $182 per share and a high stock share price at $200 per share. Now, best yet is Pepsi's dividend. They're coming in at a dividend yield of 2.78%. Moving right along to our 5th dividend stock opportunity here, we are talking about a tobacco company, that company being Philip Morris, ticker symbol PM. Now, Philip Morris was founded back in 1847 and has established itself as a dominant player within the industry, with their most recognized brand being Marlboro, but a multitude of products selling in over 180 countries, with a lot of exposure in both Russia as well as Ukraine, not only operationally, but market share wise as well. Now, taking on about 8% worth of a loss in sales alone. Now, ultimately, their stock share price certainly took a beating, falling from around $111 per share all the way down to $88 per share. That is creating about a 20% opportunity for the long-term value investor to just pick up a rock-solid dividend investment. With their PE ratio hovering around 15%, this is quite a steal, with analysts only projecting their stock is going to recover, coming back up to a median stock share price of around $115 per share and a high stock share price at $122 per share. However, the best part about investing into Philip Morris is that dividend. It's coming in at a current dividend yield of 5.33%. Now, if you're opposed to investing in a sin stock per se, you can go, on the other hand, invest into a company like Procter Gamble, ticker symbol PG. It is a consumer goods company that was founded back in 1837. Procter Gamble is focused on consumer goods. And while you wouldn't necessarily think they have a lot of exposure to Russia, they do in fact have that exposure, and they're reducing their portfolio as well as the products that they're selling in Russia, keeping it to the bare bones hygiene, health, and personal care product items, not to mention suspending all of their advertising activity as well. However, the biggest impact for Procter & Gamble comes down to them closing their Tide, Pampers, and Gillette divisions that were all based out of Russia. And while Russia is only about 2% worth of Procter & Gamble's global sales, their stock share price certainly did take a hit, falling from around $164 per share all the way down to $143 per share, roughly a 12% opportunity for that long-term value investor looking to double down on a standout dividend investment. Their current PE ratio is coming in around 25%. Now, analysts only have expectations that the stock is going to rebound, coming right back up to a median stock share price of around $175 per share and a high stock share price sitting at $187 per share. Of course, we could just collect on Procter & Gamble's dividend, very reliable, with a dividend yield coming in at 2.34%. And last but not least, a stock that I've been talking about for quite some time now, it is T. Rowe Price Group, ticker symbol TROW. T. Rowe Price is an American global investment management firm. They are focused on funds, advisory services, and account management for both individuals as well as institutions. Now, the firm was founded back in 1937 and has become a dominant force within the industry with $1.6 trillion under management. The vast majority of those assets directly tied to the stock market, ultimately meaning when the stock market is volatile, the Rowe Price Group stock itself actually slips and slides right along with the market. It's exactly what's been happening. It fell from around $200 per share all the way down to $136 per share, roughly a 32% discount opportunity for that long-term value investor with a PE ratio that's coming in around 10%. And as these geopolitical issues dissolve, inflation slowly but surely comes down. Analysts are expecting that Rowe Price Group will be coming right back up to a median stock share price around $159 per share and a high stock share price at $198 per share. Now, until it makes that rebound, we're just collecting on Rowe Price's dividend. It is a current dividend yield of 3.12%. Now, YouTube, there you have it. Between McDonald's, Starbucks, Coke, Pepsi, Philip Morris, Proctor Gamble, and Rowe Price Group, these 7 dividend investments that I'm highly recommending each and every one of you at least look into. Keep in mind, I am not a financial advisor, so always do your due diligence after watching my videos. However, if you like what you heard, you learned something new, thinking about investing in any of these companies, drop those comments below. I'd love to read through them. And as always, tap on that thumbs up button and help me grow this channel. If you haven't already subscribed, make your way over to doing so. I want each and every one of you on this journey with me. Now, YouTube, until the next video, I will see you all there.